Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our strategy of the week update here for June 29th, 2023. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. We have, weather markets that can swing both ways is the simplest way to open the discussion, right, about what are the driving factors on row crops right now, particularly corn. We had a forecast early that brought the hopes of rain. We didn't see that. We had a big run up, for the first half of June, as the reality of maybe drier forecasts or missing rain started to set in. We saw a big hole in the middle of the country, so to speak, in terms of rainfall. Which I guess that's not a bad place to start the discussion. And if you look over the last, 30 days or just back to June 1st, right, the map and how we filled out with rainfall across the United States, I think, is also the tale of how, we traded price action in corn, right? Early in the year or the month, we needed to price in the drought conditions that are still persistent on the map. This area in the center of the country. We are way behind on rainfall in Illinois, parts of Missouri, Iowa. Here's a area just right outside of Peoria, which over the last 30 days has seen 1/10 of an inch of rain. That's not great, and that's not. They're not alone in that how bad that drought is in that area. We just haven't seen that heat, right, to really bake out a crop to make us convinced that you're doing a lot of damage. Now today, right, we have this weather system coming through and barreling in on literally that area of the country, and we could not, want more than ever to hear from boots on the ground on how rainfall is happening in this area. Everywhere from basically Rockford down to Springfield, Illinois. How much of this, and even down to Mount Vernon, like just the whole state, how much are we getting here? Is this the drink that the weather meteorologists and weather analysts were promising? Or is this just, what some were fearing might have developed into a derecho with very high wind gusts and generally speaking, what could be pretty damaging? It's worth looking at how the wind right now is behaving here. Observation, we're going to go wind direction and wind speed average, but I want the gusts over the last 10 minutes and last hour or so. Let's just see if we can't get, there we go, some data on how big the wind is in real time here. Because if this storm, doesn't bring rain, and oh, here we go. This is what I was fearing to see, 60-mile-an-hour wind gusts in Springfield. We saw these wind gusts in Quincy not too long ago. So this storm is definitely bringing, pretty substantial wind. And if there's not rain or, we're getting battered down and it's just dry, and it's just hail or whatever, that's what we want to, that's what we're waiting to now see in terms of what this developing weather system or, what's happening in real time right now. And probably a good reason we go out kind of towards lows on the charts for the day. I'm not that impressed with our 10-minute average speed. Wind speed, these were much higher over here in Iowa. Quincy through Columbia here, we were seeing, 10-mile-an-hour or 10-minute average wind speeds of, pushing 40 miles an hour. That has really died down. So anyway, we're tracking the system in real time because there's a very interesting development that had some interesting wind speeds, and now we're trying to figure out how much weather or how much rain this is really bringing to a part of the country we really need to see it. In the last 24 hours, we don't really have much data coming in yet from some of the weather stations that are actively collecting this data. So we will be able to confirm what people may be saying on social media and whatnot if this if the rainfall is light or not from that what looks like an impressive system. We all know what the temperature and precipitation forecasts look like going forward here for the next couple weeks. Still bringing some slightly above average temperatures, but this above average precipitation in the GFS model that, we will see if it all comes to fruition and brings rain where it is needed. Price action today for December corn, I think, was incredibly reflective of, this weather market. You get two storm fronts barreling through a part of the Midwest that is otherwise in the worst drought condition, right? Or for the last 30 days has not gotten enough of a drink, where other places have gotten 1.5 to 3 inches at times. Like we looked at there, 1/10 of an inch. This rain could go a long way if there wasn't damage done to the crop already, right? And that's the other missing piece of the puzzle, that if we knew a little bit more about how these, stress plants will respond to the rain if and when it's getting it now, because is it just too little too late? And there is an argument to be made for that, but it's also arguments to be made how rain still makes grain. So below the 100-day moving average, below the 55-day moving average, all the work the market had done to build up and get back above all these old resistances, we have just come right back down inside of. So to me, this is both sides of the market, shorts and longs. Anyone trying to use these areas as support or resistance has just been cannon fodder for the last month. And we are right back to where we were in May. And to end the month of May. So when we take a bigger step back on the daily chart for December corn, we're seeing somewhat of a false breakout narrative from those trend lines that were above the highs, because we went above them and quickly back below. But this could also be kind of the tenuous price action of a big range developing, a new normal somewhere between 480 and 640 December corn. I'm giving ourselves a few pennies below the current low and a few pennies above the current highs of the last month to discover price, if you will, without having to dictate this narrative of going to new contract highs, right? I think we've seen enough out of weather this year that there's enough uncertainty as of right now that we can paint a picture and a narrative to get to new contract highs, but you can also paint that picture and narrative of how we go sub $5. And if anything, the chart is pointing to sub $5 right now more than it is to contract highs. I still have hope that there's, that this is back and fill, so to speak, price action to fill that 531 gap. But that's what yesterday was. Today is the fear that we're going below that gap and now holding it as resistance as the longs get squeezed and are, clearly in a max pain type of period and swing for the market. If you think of it, the psychology of what's been going on in the last couple weeks. Okay. Definitely oversold in daily RSI, and this is a pretty big move to the downside pretty fast. So the same argument you could have made while we were above 620 of going too high too far. Now we've fallen too far too fast in some degree. But we have a weather market where we're getting rain, where a lot of traders over the last several weeks were certainly convinced we couldn't if we were breaking out above $6, right? That's the narrative there. Well, when that rain came into the forecast, that fear and the worry of exactly this week happened, and now we're seeing the wind being drawn out of the sails for that weather premium. I anticipate probably bouncing back towards some of these broken now, levels that we've come back below to test them as resistance. But there's really no telling and trying to catch the falling knives at this point. And certainly yesterday when I was looking to position, now that, okay, maybe we're into a level where there's some support and we've fallen far enough, there's a reason we put protection below any long futures position. There's a reason why we, advocate for having established a floor in price in this environment, because we can still leave the upside open if the market starts to rally again, right? If that weather premium needs to be baked back into the cake. But if you're dead wrong in that assessment, um, we're going to have to, collapse to try to find where that demand needs to be. And I'm not so certain that that won't be the narrative for the rest of the year. Which brings us into Friday's report. Quarterly grain stocks will establish, at this point, where we are at the end of our, or at the start of this marketing year in terms of our carryout. And then we are just settling on production for the next several months. And, to take that narrative further, how much demand, will eat away at production and those prior stockpiles. Corn coming in at 4.255 billion bushels on trade estimates. That's slightly lower than the 2022 ending stock of in the June report of 4.349. But when you add in the potential production of this year, with a 181 trend line yield, and assuming what the USDA has already told us in 92 million acres, coupled with the added demand they added on, we're not really left with a necessarily super tight balance sheet again, and that's the narrative right now of why rain, bringing us back to the yield potentials that we probably were discounting, makes for an economic discussion of what's going on in price. Old crop, new crop right now is reflecting that greatly. I mean, yes, it's end of life for the July contract, which that's a good reason why we moved, I think, 26 cents here in the July, August, and 29 cents in the July, December, or November. But that bull spreading and that big movement in these spreads, trying to price in that difference between old and new crop production, knowing that quarterly grain stocks on Friday is a big proponent of the finality of where we begin and build on that base. It's going to reflect it on the charts, and so I'm not so certain, what to make of big bull spreading in those on generally. In generally a down market, but that was actually a trend we saw yesterday in the corn. We saw bull spreading on a down day, and it was simply because November or December in our deferred months were falling farther, faster, which today was generally the case between September and December corn. As I've kind of flipped and stopped paying attention to July as a trading vehicle. Now July is just hey, let's pay attention to deliveries vehicle and how that's behaving into for fundamentally there. But September and December corn still should start to kind of reflect the current carry needs of the market, and at a 5-cent difference here, we have to wonder for what is that, September, 4 months worth of carry, or 3 months worth of carry at, by the way, interest rates are way higher than they've been. So it seems a little narrow right there. And I wouldn't be surprised to see more spreading to try to build more carry into the market at some point, particularly if prices are starting to go south, which might mean the safe play here, or the safer play for a trade, or a way of having some downside exposure right now. One means of doing so may be bear spreading. If we're wanting to play somewhat of a weather market, I think being long December is still an advantageous thing, but selling September against it, with the anticipation of potential carry coming in a bear market, would be an interesting dynamic to see if it starts to play out. Now, you have to be careful, because in a weather market where things turn bullish, these types of spreads can go the other way very fast, and without managing risk on it and taking a look at. So I'm going to actually throw it up right here to see where the high was, because that would be the first place you wouldn't want. We wouldn't want to see it go above. All right. So I mean, it's been Look, September, December has been bear spread now since June of 2022. Pretty clear that we might have been trying to come back over that 18-day moving average, but now coming back below. So I would say even money here is where you'd want to pull the ripcord. In other words, you can bear spread and look for continuation lower towards, full carry here is going to take you down to, just guessing off the top of my head, but it's got to be close to 60 cents. Let's bring up corn, not beans. I was thinking beans, so corn here actually at 30 cents. You have, I'd say 20 cents of potential carry to still build into this market. And this might be, something you don't trade. This might be the thing you watch as an indicator for when, corn might want to bottom out, is if this thing starts to go towards full carry. Because then at that point, there's, with a high potential for a weather market, right? These things could snap back, and certainly off an area like for carry where it can't really go below, ends up becoming an interesting floor for the market to head towards. All right. So today's close didn't leave us with much to sink your teeth into, with the exception of to get through kind of some of the fundamentals and how they're playing out with the weather markets. Didn't give us much to really sink our teeth into in terms of a reversal signal, because they effectively failed by going back below that gap. We're still below many trend lines, right? So there isn't any kind of support that was maybe there last night, has now broken, and arguably now been tested as resistance. And we've continued the trend lower in the near terms from the 629 high. We are trading back into some of the original breakout levels, which, other than the fact that they were participated on before, doesn't give me a reason to want to participate in being long on a down here without confirmation of a reversal. And that's then when, okay, we can start to talk about a range forming, because hey, this is just one leg up and one leg down through the lows. I'm perfectly comfortable letting this fall and capitulate. But if it doesn't, we do see a reversal, of this rather steep downtrend. I think that there's the ability for this market to climb back towards $5.70 and $6, just, inside the range that we've been in, if nothing else. And even from the most bearish standpoint, then, hey, maybe the market is going to want to trade back into some form of 50% retracement off of the high, which, interestingly enough, when we get dialed down into, there could be two little gaps we left open up there, but 579 would just be a 50% retracement off the highs. Down to a 15-minute chart for December corn. $629.75 close, and basically at highs on the 21st. Was met with a reopen on the 22nd. The Globex open at 626. So we just basically gapped straight down 3 cents and never looked back to that high. The following day we closed at around 620, and then we open at 616, leaving yet another little gap on the intraday chart that really ran. So two gaps lower and running lower to effectively fill an open gap that we had left on the chart way back at the start of the month. It's kind of just a market that's wanting to close just about every gap it leaves open, and if we consider these gaps off the highs, maybe they go back there just in the up and down and uncertainty of the current weather market conditions we have, and fund flows and everything else. And by the way, a quarterly grain stocks that, if for whatever reason, which I don't really anticipate it coming in grossly below trade estimates, because we haven't had the type of demand and flash sales and environment where I think the consumption of the old stockpiles that we have is warranted, or seeing a bigger number. But I'm cautiously optimistic that that is the case, right? So we shall see if that is a surprise. But the way we've been trading is really hyper-focused on weather, at least the market price action as I see it. Okay. November beans and August beans holding up far better than the corn complex right now, which is a, possibly reflection, right, of just generally, maybe the tighter, situation you could make for beans than corn in terms of carry out. But demand is still in question across the board. And it's really interesting to all of us analysts that expect weather markets for, August or beans, to be in August and a little towards the tail end of the year, right? It's interesting to see them just holding up better, right? At a time when the bean plant has far more opportunity to recover. And I think genetically speaking, there's a lot, of discussion about how there's more room to the upside in, for bean production to increase on a national average yield. This isn't probably the year to test that theory just yet, but needless to say, August beans 1368 into the end of the day, Novi beans 1265 into the end of the day, and I'm really amazed that Novi beans here to me look just like a market pulling back into a 50% retracement and still holding above the 55-day and 18-day moving average. They're like the one glimmer of hope in the row crops right now that really held some levels that, could give, the bulls of real reason to be positioning here, right? And saying, oh, well, there's a line in the sand and, my level's holding and I've put my stop here and my target's up here. And whereas, right, we were the similar levels in December corn have completely been, hunted and run through. That's the nature of the wrestling match. I think there's just more volatility in corn right now because of where we are in its own cycle. So Novi beans, though, closing barely positive on the day. Still, I think, a big win on the chart technically, and still above that 18-day moving average and that 55 days. So staying there. Not quite oversold though on that RSI. I think I'd feel a little more comfortable if that were the case, but to then feel like we had really put in had a whipsaw, but that's fine. Same story on August beans, only we are holding up far higher, in terms of a relative retracement. August beans have only pulled back about 30% of that same rally, and that's a reason why yesterday we talked about I was looking into the September timeframe and using September options, trying to go for that near term, going for the near term contracts because I felt they should be trading more like old crop. And at the time, right, and as we see, July is still being wildly bull spread here. So still bringing those bean bids, so to speak, to in the near term seems to be the way the market is demanding. Or continuing to demand, right, soybeans now, rather than pricing in the desire to store them, which would ultimately send our deferred months better bid and be bear spreading in those spreads. Okay, we'll see. Let's break down the smaller time frame chart here for soybeans and settle this week out as there aren't many other markets to comment much on. All right, so Novi beans, the big win here on Novi that I will continue to kind of be impressed by, and a big reason why I feel like even corn in December could still be in a range, right, is when you look at November beans, we just capitulated below the 1220 figure, right? 1220 to 1240 was our big supportive area coming excuse me, out of 2022. The old lows in the contract down there at around 1220 and had held for all the way through May of this year. We tested them again there in April. We went below them just for the month of May and part of June to rally back above, and now come back in June to close the month, testing that area now as potential support. Yeah, if this is a low where into the start of July we can bottom and start heading higher, this all looks like a market trying to establish some big support, even though there's possibly a ceiling above, and that leads to much larger ranges, which clearly price discovery for this market has had no problem trading, the $2 and almost 50 cent, but $2.25 range between, the 1140 area to the, almost 1400 area. And given the weather markets and everything we're seeing, I think that there's a high probability that those ranges continue to trade until we really see them break out. That doesn't mean you can't structure reownership above the high end of that range, right? Get ready for the crazy situation that still could happen if we turn really, really hot and get really, really dry. But again, we need to see that narrative play out. I think we can all agree that wrecking ball of a storm coming through Illinois today is a big reason why, right, we would be down. If the argument was that this part of the country needed rain and was having trouble, well, today we brought some. Saturday and Sunday we might get some more. The only question now that can be made against that is how well, right, things can recover with that. Chicago wheat pulling back into a very big 50% level as well. Very similar to our November beans here, but this is the September contract for Chicago wheat. Kind of more down into that 61.8 line of that pullback, but it's the old breakout highs as well, right? From the start of June, that 660 area we broke out of, come back down to test it. Old highs now a support, 50% pullback, and potentially a little bit of a channel forming to the upside for wheat. If this sticks, we'll have upside targets for a channel resistance and, the 50% pullback with an 813 potential swing target, as long as we generally stay above the 650 area here. Fortunately, with a long weekend and everything coming up and news on Friday with wheat quarterly grain stocks expecting 611 million bushels. What's that? 87 lower than last year at this time, and 355 lower than, or excuse me, 335 lower than last month, or the March report. Last quarter, I should say. These are quarterly grain stocks after all. But gone a whole lot of nowhere in both KC and Chicago wheat, for that matter, and really very range bound. Can't really get above $7.80 to $8 since December for the whole year of 2023. But we've also spent very little time below 660, relatively speaking, right? We were a month and a half down there, but we spent 7 other months above it, including half of this one. So establishing in kind of like a little rolling or cup and, well, this is a very big handle, but a cup and handle kind of reversal, right? The idea that it's a rolling bottom and arguably making a head and shoulders with some kind of neckline in the 770 to 740 area. Left shoulder, right shoulder. This is a bit of the head. But below 650, call into question $6 and maybe even continuing a trend lower in the near term. KC wheat, a little heavier today, down to test that $8 figure. I can't call this anything but a range between $9 and now $8, but really the 750 figure since last December. So just sideways, the market continues to crawl. Cattle looking impressive. September feeders back up almost to their contract highs again, following the October feeders, I guess, or fats just never really fell apart. The feeders definitely had a nice sell-off with plenty of island reversals. These three-day little ranges that we just gapped around, leaving some kind of this. I don't even know what you would refer to this, but it's there's like three islands, and the bottom one is certainly an island reversal. The idea being you gap down, trade in that range down there, and then gap up back out of that range, leaving it to be its own little place on the chart. Pretty bullish, V-shaped recovery. That if you draw just trendline resistance against the highs, a channel, so to speak, on the feeder cattle, you get, a projection up towards the 255 to 260 area, right, on the next potential swing higher. And if this is really parabolic, I mean, I think that's a rather unprecedented move, but we certainly have the chart that is coiling up for it. October, I was anticipating, a little bit of a deeper pullback. I wanted to see a test of the 68 figure. I, still think that is possible, but like the feeders, this is holding impressively in a kind of a pennant structure that is now breaking out, and upside projections for October towards the 185 area keep the trend higher towards new contract highs. Crude oil very sideways in a range, nothing going on there. Below highs of the month of 75 and above lows of the month of 66. We will, I think, continue to chop around and fight. Gold has been a little disappointing to see it break below the 950 and hit this 1900 area. And I'm not so certain that we won't see it even deeper pullback towards 1850 at this point, but it seems to be trying to top out here, and you can't ignore this 2100 high, 1600 low range that the market could just ultimately be in. And I think we're topping out and might be pulling back. We've cooled off with, people, I think, running to gold as an inflation hedge, and for all the reasons, right? The S&P 500, let's go out to our daily chart here, because I see the market generally trying to flag up here after its breakout above 4,300 and a gap in the continuous chart here on the futures, but flagging up generally above 4,400 probably just means continuation higher. Major support back down towards 4,200 if the swings dictate it, but this is, to me, a breakout of a consolidative range that took a year and a half to form, and coming off of that really, 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 really big full 50% pullback from the 2100 area up to 4800, right at 3500. Upside projections towards 5400 in this larger swing could be in the works. However, if this is a channel higher, support's still down around 42 to 4100 if we want to break down, but I think we're going to need to get below the lows here of June, late June here around 43.75 before any kind of significant reversal would set in. So we'll keep an eye out on into Friday right here into tomorrow for our quarterly grain stock estimates. I didn't mention beans there, but they have an 812 million bushel estimated carry out. I mean, definitely, half of what we were, the stockpiles we had in March, and 156 million bushels lower than estimates from last year. But again, a production year with potentially more acres, and the case for recovery in beans and pushing trendline yield can be made for beans more so than corn. I think just how just based off of what the numbers are and our achievability, I think we know that number, if you even question demand at all, right, that's going to seem a lot bigger than it is relative to last year, right? Because more demand up front or bigger supplies are down the road. Anyway, or less demand, I'm sorry, with bigger supplies, right? That measly 150 million bushel difference is going to be completely negated by the markets. So watch for the storm and the forecast models here into the weekend, to leave kind of everybody with the last bit of information here. We're looking at the GFS model. I'll flip to the euro in just a second, but this is showing us the 24-hour precipitation accumulation over the next few days as it kind of moves through the country. This is into this weekend. You can see through Illinois, through Iowa, potentially another, as much of it looks like as much as 3 inches in some places, but generally this is a quarter to 1 inch type of potential here again on the weekend for that problem area. If that doesn't come, that's going to hurt things. We're going to be watching, right, our actual actual rainfall here to see how the storms today actually did. If again, we're not seeing more than that little bit, and this is just wind, then it doesn't really help things. And right, all of these models continue to not bring us any hope. Going into and through next week, though, even the European model, you can see how the corridor of what looks like rainfall, has shifted, out through July 9th. So this is going out a couple weeks, right? Anticipating is getting as much as 3 to 4 inches through this area of total accumulated rainfall over the next couple weeks. So that's a couple events of about an inch, right, or an inch and a half, if it's gonna accumulate to that much. I think that's a little heavy this time of year, but you know what? If we're certainly starting to see more of the weather patterns through this part of the country that we weren't necessarily anticipating before, bringing rainfall to problem spots that we were worried about, right? So have a great day, everybody. Have a better weekend. We'll see you all tomorrow. And as price action develops, you can always reach us over here at Zaner at 312-277-0110. Find me on Facebook, Twitter, or shoot me an email at dhussey@zaner.com.